Thank you very much for the introduction, Sophia, and welcome everybody to today's webinar. I really hope you'll find it useful, and I'm looking forward to discussing foreign currency hedging and risk with Alan today. So I thought I could just start off the session by sort of setting the tone, looking at what's the next 18 months look like in terms of economic outlook. So as Sophia mentioned, I'm a director at Baker Tilly Hong Kong, but I'm also a member of the Institute of Chartered Accountants in England and Wales. And they've recently released their economic report in partnership with Oxford Economics. So as a summary of that report, basically they have said over the next sort of 12 months, just one second, just loading the page. Over the next 12 months or in 2020, it will lead to the biggest global recession in post-war history. Oxford Economics expect global GDP to shrink by 4.7% in 2020 this year. A recovery in the second half of 2020 won't make up for lost activity in the first half of this year, and they expect that the GDP will not return to pre-crisis levels until mid-2021. This shock has already caused mild permanent damage to the global economy, and the cost of the virus outbreak in the medium term could be in the region of 1.6% of global GDP, though this estimate is subject to a high degree of uncertainty. Governments have unleashed unprecedented support to prevent further long-term damage, and Oxford Economics expects global debt levels to rise by 10 to 20% of GDP by 2021 in most advanced economies. So obviously this is going to be a very challenging time for SMEs and all businesses in general. So as I mentioned, a lot of this is due to uncertainties that we're seeing in the market, and one of those uncertainties is for foreign currency fluctuations and risk. So that's why today's session about currency hedging, protecting your profit margin in a post-COVID world, will really help businesses see how can they hedge those risks going forward. So on that point, I would like to hand over to Alan, who will talk about this topic in a bit more detail. But just as a reminder, if you have any questions during the presentation or during our Q&A afterwards, just put them in the chat box and we'll try to come to as many as we can at the end of this session. So over to you, Alan.
Thank you very much, Ryan, and good afternoon. SMEs need to protect their profit margin from currency volatility. This will be our topic today. I'm very excited to talk about SMEs and the Forex market at this time. The COVID crisis we are living right now is accelerating the urgency for SMEs to protect their profit margin from currency volatility. In the past quarter, we experienced large Forex moves that impacted all businesses. This confirms the secular trend of heightened currency volatility that started during the Great Financial Crisis. What I mean by secular trend is that this period of high volatility started with the Great Financial Crisis and is set to last for a long time. As a result, more than ever, SMEs need to better control their currency risk to protect their profit margin and capital. Although my background is in Forex hedging and financial markets for the past 30 years, let me tell you how our firm, SystematicEdge, got involved in Forex hedging and working with SMEs. For background, our currency risk hedging solution that we grew come out of our family business. The business is typically Canadian and operates out of Vancouver. My father-in-law's company designed some equipment that is manufactured in British Columbia and mostly sold to the US to the likes of Ken4 and Interfor. As it is an SME, we found it too expensive to work with banks or Forex providers. They were too expensive in terms of currency conversion and hedging cost. But we needed a solution that would not erode our already slim profit margin. And we did not want to take the currency risk, which could leave us with a liability to the manufacturer greater than what we would receive from the client. And of course, one of our greatest concerns was that currency risk could lead us to bankruptcy. When speaking to other SMEs, we realized we are not alone, which led us to offer this solution alongside our other financial solutions at SystematicEdge. As I mentioned before, since the Great Financial Crisis, large currency shocks happens more and more often. This is a secular trend across all financial markets. This volatility has been persistent over the past 20 years, as you can see on these graphs. You can see what this kind of currency movements can do to the profit margin of any company doing cross-border business and why there is an imperative to hedge. Our agenda today is the following. First, who should hedge currency risk? Second, why hedge currency risk? And thirdly, we will drive you through a case study on an operating business and how they neutralize their currency risk. Here are the key takeaways from our presentation that you can action in your own business. We will review the type of risk linked to Forex. We will go through the instruments used to hedge Forex volatility. We will explain the FX hedging process to secure your profit margins while compressing costs. And we will highlight what to look for in a Forex hedging solution. First, who should hedge currency risk? Basically, all SMEs doing cross-border business in several currencies. Manufacturers, such as companies manufacturing in China, selling to European clients. Service companies, for example, consultants, invoicing fees in several currencies and paying costs in several currencies. Trading companies, such as import and export companies. SMEs, negotiating a cross-border exit or acquisition. Investment firms, for instance, having USD investors and assets in Australian dollar. However, even though all of those companies should be hedging their currency risk. So what are the reasons not to hedge cited by SMEs? First, the perceived complexity of Forex hedging instruments. It's not so surprising. FX hedging is a very specific expertise. Secondly, cost. The first customer experience SMEs have with Forex is when they need to convert money from one currency to another, typically with the banks or an online Forex platform. It may not be a pleasant experience because in most cases, converting currency using an intermediary is costly, and many realize the full cost after the fact. Online Forex platform can make their site very pretty and intuitive to use, yet many of them are just intermediaries between you and the bank and could be as expensive as a bank. Third, the lack of a turnkey solution. SMEs need a roadmap to analyze their currency risk, establish a hedging program that can be implemented in their company and fit their business needs. These reasons are subjective, not based on risk. That is why when we work with SMEs, we do a case study for them so they can understand and analyze how the hedging process would work for their business, with what cost and benefit. Then they can make their informed decision on how they wish to proceed to hedge their currency risk. Why hedge currency risk? There are four main currency risk and cost. Currency volatility risk, counterparty risk, currency conversion cost, and hedging cost or profit. First, let's talk about the risk. First, currency volatility. That is what can wipe out your profit margin and generate operating losses. SMEs need to hedge to immunize their profit margin from currency volatility so they can forecast their cash flow more precisely and increase profitability. The objective of a business is not to gamble on the currency market, but to secure their profit margins. If you have a view on the currency and on its direction, although academic studies demonstrate it's not possible to predict or time the market, then you can express that view in your personal investments, not in your business. Ryan and I will talk about the importance of this in more detail during our discussion. But for those SMEs that do not hedge, how do they handle this currency volatility? We have seen many different techniques when speaking to clients. But one of the most common is pricing in a buffer, which means they add a buffer of 5 to 10% to their markup. This is good, but not good enough, because it does not cover large currency fluctuations, and it makes the SME less price competitive. So what we explained for those who are using this buffer technique, if they hedge, they can lock in an extra 5 to 10% on top of their profit margin, or whatever the amount of the buffer was. In other words, when they hedge, they can either put this buffer in their pocket and improve their profit margin, or become more competitive and sell more of their products and services. Second, counterparty risk. It is the elephant in the room that is too often ignored, and that can be fatal to a company using an FX provider with weak credit worthiness. A recent example of this is the 2 billion euro fraud of Wirecard, a German payments platform where clients were restricted from accessing their accounts. Let me show you the 3 main cases on how corporations access Forex hedging and the one that avoids counterparty risk. Case number 1. When you do your Forex transaction with a bank, this is what most large companies do, but it's not the most efficient way or the most effective. And it's difficult to access for SMEs because they would need a credit line with the bank. In this case, at least you have an account with a bank, which typically has good credit. So the counterparty risk is mitigated. Yet the bank is an intermediary, and you will not have direct access to the Forex market, which allows the bank to take a markup on the Forex rate. For instance, 0.5%, and that can be much higher from talking to clients. Case number 2, when you do your Forex transaction with an online Forex service provider. This is a more recent development due to the emergence of online Forex platforms that are intermediaries between you and the bank, and they will take a fee between the wholesale price of the bank and the end client price. Some online Forex providers use currency delivery versus payment, DVP, where the SME is asked to send to the Forex provider the full amount to be converted and therefore bear a 100% counterparty risk on the amount sent. Case 3. This is the case that avoids counterparty risk. When the SME has a direct market access, DMA, to the futures exchange market. That is the solution we provide to our clients. The SME will open an account with a broker that provides DMA to the exchange, which is regulated and bankruptcy remote. In this case, there is no intermediary service fee. The SME is left to pay the DMA fee from the broker, which is a small fraction of what they would pay to a service intermediary. Also in this case, by definition of the exchange, the SME has complete transparency on the price and will execute its Forex hedging transaction at the best available price in a completely secure and regulated environment. Now let's talk about the cost. Currency conversion, recurring cost. Currency conversion needed in the conduct of business can in itself generate recurring cost if the currency market is not accessed efficiently. That happens when an SME is not using direct market access to convert Forex. It is going through a Forex intermediary involving layers of fees on top of a bid-offer spread that can add up to many % a year, eroding the company's profit margin. And finally, number 4, hedging cost or profit. A currency hedging transaction is performed over a certain amount of time. Depending on the currency pair, a hedge can generate recurring positive profit or loss due to the interest rate differential between the currencies. We will illustrate this in the following case study. So we just went through the risk and cost associated with cross-currency business. Now I wanted to quickly give you an overview of the main instruments used to manage currency risk before we move on to the case study. Forwards, futures, and options. First, forwards. A forward is a non-standard contract between the SME and a bank to exchange money denominated in one currency into another currency at a pre-agreed exchange rate on a specified date in the future. In other words, when transacting a forward contract, you agree right now on all the terms of a currency conversion, but the actual currency exchange happens at a future date. What is important for SMEs to understand is that a forward is used to neutralize the currency risk of a commercial transaction. Therefore, when there is a currency fluctuation, if you gain on the forward hedge, you will lose the same amount on the commercial transaction. A forward contract involves counterparty risk as the SME is facing a bank, which will need to open a credit line with the SME. For this service, the bank will charge an intermediary fee and will hedge itself in the interbanking market, which the SMEs don't have access to. Therefore, the forward pricing is not fully transparent. Second, futures. As opposed to a forward, a futures is a standard contract between the SME and a futures exchange, such as the Hong Kong Futures Exchange, the Chicago Mercantile Exchange, or Globex. For the rest, it works the same way as a forward. The differences with a forward are: number one, there is no counterparty risk as the SME is facing a futures exchange, which is regulated, collateralized, and a bankruptcy remote entity. Secondly, there is no intermediary and therefore no intermediary service fee. It's a direct access to the listed FX market on the exchange. Thirdly, consequently from 1 and 2, futures pricing is fully transparent, and by definition of the exchange regulation, all trades are executed at the best available price. That is why our hedging solutions privilege futures instead of forwards. Third, options. A currency option is a derivative instrument that gives the right, but not the obligation, to exchange money denominated in one currency into another currency at a pre-agreed exchange rate on a specified date in the future. The buyer of the option must pay a premium. In other words, an option is an insurance on a currency rate fluctuation. As there is no obligation to exercise an option, this instrument is appropriate for the following situation. A, to hedge currency risk for uncertain future cash flows. B, for those who want to keep the currency upside in their commercial transaction and yet neutralize the downside risk, of course, in exchange for paying a premium. Options can be traded with intermediaries like banks and online FX platform, or directly in the listed Forex market on the exchange, which is what we do at SystematicEdge. I will illustrate in the case study when you want to use futures and when you want to use options. So we went through the risk, the cost, the instruments to manage currency volatility. We're now ready to explore the case study. Let me describe the case situation first. ABC is a Canadian trading company with Canadian dollar as its base currency. ABC buys a shipment of goods from a Chinese supplier for 3 million RMB. The payment in RMB is 3 months later. Based on the prevailing exchange rate, ABC expects to make a profit margin of 10%. In this situation, ABC is exposed to the Canadian RMB currency risk. If Canadian RMB decreases during the next 3 months, making the cost of goods more expensive in Canadian terms, ABC's margin will shrink. And if Canadian RMB increases, making the cost of goods less expensive in Canadian dollar terms, the profit margin will increase. There are 2 ways for ABC to hedge its currency risk. Either sell a Canadian RMB futures contract for an amount of 3 million RMB, which would lock in the FX rate, making ABC's P&L insensitive to currency fluctuation, or buy an option to sell Canadian RMB for an amount of 3 million RMB, which would protect ABC's P&L against adverse currency fluctuations while allowing it to benefit from a favorable currency moves in exchange for the payment of a premium, similar to an insurance premium. In this case study, we compare the impact of implementing a hedge versus no hedge. We measure this impact on the company's P&L and profit margin under 2 scenarios. Number 1, Canadian RMB decreases 10.6%. Number 2, Canadian RMB increases 10.6%. Scenario 1, Canadian RMB goes down 10.6%. I don't want to spend time on these accounting slides, but for your information, they illustrate the accounting details of this hedging transaction. If you're interested, contact us and we can send them to you. 2, Canadian RMB goes up 10.6%. And now let's analyze the results. This slide summarizes well the impact of Canadian RMB fluctuations on the company's P&L. As you can see, without hedge in purple, in the scenario where Canadian RMB goes down 10.6%, on the left side of the slide, ABC's profit margin is wiped out, and ABC marks an operating loss. ABC's profit varies substantially depending on the direction of the exchange rate. This creates profit volatility, which is something companies don't want. Hedging with futures, in green, we can see here that the 10% profit margin that the line in red represents is fully immunized against changes in the currency exchange rate, with a small additional profit in both cases, thanks to the positive carry of the future hedge, which is the result of the difference between interest rate in China and Canada. Moreover, currency hedging allows companies to trade in the supplier's currency, in this case RMB, potentially allowing them to benefit from better price in local currency. As with hedging with options in blue, we can clearly see on this chart that the option protects the company's profit against a decrease in Canadian RMB on the left side of the slide, while benefiting from a surge in the exchange rate on the right side of the slide. On the other hand, the profit margin when hedging with an option is 1 percentage point lower than the expected margin. In this example, due to the premium paid to buy the option. Depending on the situation, sometimes it makes more sense to hedge with futures, sometimes it makes more sense to hedge with options. But in both cases, the hedge allows the company to completely eliminate the profit uncertainty generated by foreign currency volatility. From the case study, you have seen the value of using futures and options to hedge currency risk. Now, let me break down for you the process that must be followed to implement a currency hedging solution. The first step is to carry out a detailed currency risk analysis of the company's business. In particular, we need to identify certain and uncertain cash flows in foreign currencies and their schedule. We also need to measure the sensitivity of the company's revenue with respect to currency fluctuations. Second, based on that detailed currency risk analysis, a customized forex hedging program is designed. Its objectives are to immunize the company's profit margin from currency fluctuations and to optimize the hedging carry cost or profit. The third step is the implementation of the hedging program, which includes currency conversions and the execution of hedging trades, namely futures and options. At this step, it's very important to minimize the cost at all levels of the hedging process, which means minimizing the number of transactions and also using the most liquid and transparent instruments, for instance, favoring exchange-traded futures over banks' forwards, and also executing currency conversion and hedging instrument at the best possible price, which should be mid-market or very close. The fourth and last step of the forex hedging process is risk management, which is the continuous follow-up of the hedging process to make sure that at any given point in time, the company's P&L is completely immunized from currency fluctuation. At this point, you must be asking yourself, okay, I understand the benefits of forex hedging for my business, but how do I choose the most suitable solution for me? There are many forex service providers, including banks, brokers, and online FX platforms. Not all of them provide hedging solutions, but for those who do, there are three key features. The solution must be cost-effective, safe, and include a turnkey solution that can actually be implemented in your company. So, number one, cost saving. The key points to look for is whether the provider offers mid-market currency conversion and direct market access to trade hedging instruments at the best price. Secondly, safety. As discussed before, choose a hedging solution to avoid counterparty risk, where all the parties are regulated and where the workflow implementation is straight-through processing, STP, in order to have real-time access to the risk reports. STP is also very important to avoid operational risk. Third, last but not least, is the service provided a turnkey solution that I can implement in my company. A turnkey solution would include the 4 steps of the Forex hedging process I described in the previous slide. Now the presentation is finished. Let me summarize the 3 key messages for SMEs doing cross-border business. To maximize their profit margins in a cross-border business, SMEs need to first hedge their FX risk. Second, compress FX cost. And thirdly, use a safe environment to implement their FX hedging solution. That means avoid counterparty risk. And now a few words about us. Our firm, SystematicEdge, is a financial services firm specialized in liquid investments and currency risk hedging solutions. We work with SMEs, family offices, high net worth individuals, and funds. If your company is doing cross-border business, feel free to contact us. We'll be happy to provide you with a free currency risk analysis and case study specific to your company's business, similar to the one I showed you. This way, you will be able to objectively understand how a hedging process can be implemented in your company, what are the benefits and costs. Then you can make an informed decision on how you want to manage your currency risk. Back to you, Ryan.
Thank you very much, Alan. That was a great presentation there. I think you really went through the comprehensive review of the different tools available to businesses, and also the key risks and costs. I think one of the ones which a lot of people tend to forget is the counterparty risk, which is definitely something that businesses need to be mindful of. So I think in terms of our clients, I thought I could just share some insights of what they are seeing at this moment in time. So you've mentioned a lot about cash flows, and I think that's very important at this moment. As we like to say, cash is king, and businesses are very mindful on what is their cash position and their profitability. So a lot of businesses, they need to do cash flow forecasts, and those are coming under more scrutiny than ever before. So banks are looking at these for potential lending opportunities. For existing lending arrangements, they're also looking at those to ensure the creditworthiness of their clients. Investors are looking at how are the businesses performing under these challenging circumstances. And key management also need to make a lot of decisions, especially on a prompt basis at this moment in time because of the uncertain environment that we find ourselves in.
They will tend to use futures because futures are the most efficient. You don't have to pay a premium. It's very, very cost efficient. So they will use futures. If you take the example of F&B, food and beverage, take the famous example of the wine importer, let's say from Europe, from France. There are 3,000 French wine importer in Hong Kong, if you can believe that. Well, in their case, you see, their business is actually, their revenue is correlated to the level of the currency, to the euro dollar. Because when euro goes down, obviously the price of wine is cheaper when they sell to China, and they sell a lot more. And when the euro goes up, well, wine is more expensive, right? And so they sell less. So they do take this into account. So what they want to do is, typically these guys, sometimes they use options, right? Because if the euro goes up, they want to be able to exercise their option to stay competitive and to protect their profit margin when euro dollar is going the wrong way for them. However, when the euro goes down, all of a sudden, they make extra money, they become more competitive, and they do more volume. So they don't exercise. So that's why, that's an example, F&B, where they use options. And third, very specific example, for instance, are the real estate investors. Whether it's direct investment in real estate or through funds, I mean, typically they like to use futures. Why? Is because with real estate, I mean, they need to invest and hedge for a very long time, for many, many years. So here as well, they need a very efficient, very cost-effective way to hedge, very transparent. That is why they use future.
Okay, thank you very much. I think you mentioned also in your slides earlier on that maybe only 20% of SME businesses are actually hedging their foreign currency risk at this moment. So although maybe 80% are using futures, there's still a lot of SME businesses who aren't hedging at all. And I think we do tend to see that. And the problem is there will be a lot of fluctuation in their profitability. I think some of your graphs have shown that. And our concern at this moment in time, in terms of all the uncertainty that's in the economy, you know, a lot of these businesses before, they were showing a large FX gain in one year, a large FX loss in the next year. But when they've got a large, say, net profit or operating profit, sometimes that's not easy to see. But now, once profit margins are going to be reduced just because of the reduction in volumes of trade, you know, this is going to have a much more significant impact on their overall profitability. And that could start to bring some concerns to the users of the financial statements, particularly those who have got banking facilities with, say, covenants such as gearing ratios, interest rate cover, or liquidity ratios. Once these foreign currency risks start to realize on the balance sheet, there's going to be a lot of stress on there and potentially breach some of those covenants. So I just wondered, when you worked in the banking side, Alan, what was your experience on this subject? You know, would the banks be quick to recall loans, especially in times like now where maybe the risk of default is higher? Or would they give some leniency to the businesses, or potentially even adjust the covenants for factors like foreign currency gains and losses?
Sure. So when a bank is going to analyze the business and the solvency of an SME or a corporation, they would look at many things. But for instance, of course, they would look at the earnings, right? And so for a company that's not going to hedge basically the cash flow and the earnings in foreign currency, that will be a problem, because what the bank will do, the bank will use a scenario, a conservative, basically currency fluctuation scenario to apply on the earnings, okay, in order to be conservative in their assessment. So that means that a corporation that doesn't hedge the foreign cash flows and the foreign currency earnings will have a big haircut from the bank on the earnings to take into account this currency volatility and this currency risk. So of course that will affect negatively the creditworthiness of the corporation. Also, at the governance level, obviously this is the role of management to manage the risk of the corporation, and the currency risk is one of them. So not hedging currency risk is not best practice, and that will affect the sustainability of the business in the long run, and therefore the solvency as well. So that's the two aspects that will really affect the creditworthiness of a corporation. So hedging having hedging their earnings and also having a clear hedging process at the governance level.
Yeah, I think that's completely right. Like you said, the going concern issue that I mentioned in my first point is a very hot topic in terms of businesses. You know, we're all facing a challenging time, and so the uncertainty around the currency risk. You know, if you are able to hedge that risk and able to put the business in a better position, obviously that is more important from a governance perspective. So trying to move on from the doom and gloom, I mean, most of my comments have been about, the economic climate that we find ourselves in. But, we do have to remember that there are a lot of opportunities. A lot of businesses, they have done exceptionally well during this pandemic period, such as online businesses, PPE manufacturers, or healthcare providers. We've also seen a lot of businesses diversify themselves, such as F1 teams have started making ventilators to help those in need. So I do think once we start to get out of this pandemic period, there will be a lot of opportunities for those businesses who have done well, perhaps a lot of M&A opportunities to expand into new markets, pick up business distressed assets on a bargain purchase. But obviously these could be subject to FX risk depending on where those acquisitions are going to take place. So just wondered, Alan, is there any other areas that SMEs need to think about when they're hedging these sort of opportunities?
Oh, absolutely, absolutely. Well, in the case of M&As, for instance, and also the private equity business and the venture capital business, obviously on one side, you have the investors' currency, right? That can be, let's say, US dollar or other currencies. That's the liability currency part of the deal. And then you have the corporate target or the asset currency. So on both sides, the investors and the corporate target, right? I mean, they will have to resolve an asset liability currency mismatch, right? So there are two solutions. Either the currency hedge happens on the investor side, where that means that basically they will swap the investor initial funding, natural funding, into the currency needed to acquire the target, or that will happen on the asset side, on the corporate target side, where they will need basically to put a hedging process in place. But in any way, obviously, when a corporation wants to acquire another corporation, they will analyze this corporation, the target corporation, and they will look at what happens. They will look at the foreign cash flows, and they will look if there is in place a hedging process. And if not, they will have to put a hedging program in place or adjust the hedging process in order to complete the transaction and resolve the asset liability currency mismatch.
Yeah, definitely. And I think, a lot of these transactions, they will be of significant amounts. Potentially, sometimes there are contingent considerations, which are based on performance targets in, say, 1 to 3 years. So it does expose the investor to significant fluctuations in currencies over that period of time. And I think, like I say, once those acquisitions are taken place, there will be expansion to new markets, so you need to think about the strategy. On that point as well, I think, post-pandemic, a lot of businesses, they are looking to diversify. We hear a lot of clients saying perhaps they were too reliant on a particular supply chain or a particular market. So once these lockdowns started a few months ago, it really did impact their business continuity plans. So perhaps they're now looking to diversify to come up with new supply chains or new customer bases. So again, that will obviously create some FX risk to those businesses once they move into those new markets. So Alan, I just thought, when businesses start to adopt these new strategic decisions, when should they start thinking about hedging? Should it be right at the beginning when they start to look into those new markets? Or would it be once they've kind of established themselves, got their foot into the door, and then they start to see what is the volume of trade they're going to be doing there?
Well, I mean, it is never too early in a business, in a cross-border business, to think about currency risk hedging. Why? I mean, number one, if you launch a new business within your company, it's a cross-border business, I mean, you will need to forecast your profit margin. So you will need to understand how you will protect your profit margin, right? So you need to think about your hedging process. I mean, secondly, for SMEs that will do cross-border business, I mean, obviously they need to address the fact that they will deal with clients and suppliers in foreign currencies, and how are they going? Will they be able basically to hedge this flow in foreign currency? And lastly, as soon as you have within a cross-border business, they're going to have different amount in different currencies, and they're going to do business in different places. So they will have this cash liquidity management to perform. And it's going to be very important to manage their business. So they need to understand in advance how they will perform all these actions. And of course, because they will need to hedge, they will need to address the fact, how do I optimize my hedging costs as well? So that's why it is so important, and it's never too early to think about currency risk hedging.
Yeah, thank you very much. Completely agree. So I think we've got around 10 minutes left, so maybe we will move on to any Q&A that's in the chat box. I've seen a couple of questions come in already. So if anyone has any questions they would like to ask, please put them in there and we will pose them to Alan and myself. So we've got one question at the moment, Alan. Please could you help to explain again about how to get 3% in the money market when you talked about cash management?
Yeah, so when I took this example, for instance, I was talking about a corporation that would have, for instance, a business, some business in RMB, and therefore hopefully have some profit in RMB. And today the daily money market in RMB is worth approximately 3%. If you're interested in the detail on how we get the 3%, I mean, please feel free to contact us. But basically, that's what banks typically, that's the kind of return banks in Treasury Department of banks will have, or large institution. That's what you get from the money market at the moment. Of course, this is not the case in US dollar. You get much less in US dollar, and of course in euro you get zero, and sometimes you're happy not to get negative interest rates.
Okay, thank you very much, Alan. Hopefully that has answered your question, but please let us know if you need any further clarification. At the moment, we're waiting for any further questions. So perhaps I can just ask you a couple of more questions, please, Alan.
Sure.
So could you help just break down what is the real cost of hedging to a business who does embark on that?
Yeah. So bottom line, there are two main costs. Number one is the hedging FX hedging carry cost. That could be a cost or a profit. And secondly, that's currency conversion. That is why it's so important to really analyze properly how you will hedge in order to minimize this hedging cost if it's a hedging cost. But sometimes it's a profit, just like in the case study we've seen together, right? And in this case, you want to try to maximize basically this hedging profit in order to just increase your P&L. The second part of what can cost you when you hedge, as I mentioned before, is obviously the recurring currency conversion. That is why it's so important to have a setup and to find the right setup, safe setup, to be able to trade currency mid-market or close to mid-market. Otherwise, this recurring cost will add up to several percent per year and will really weigh on your profit margin.
Okay, thank you very much, Alan. We have got another question in the chat box. So if a business is currently gaining on their foreign currency at this moment in time, do they still need to embark on implementing a hedging strategy? What are your thoughts?
Of course. Well, that means this business is lucky. So I think that would be great to just, if you hedge, you're going to lock this extra profit. So it would be very interesting indeed to lock this profit. As I said before, you're right. If you don't hedge, you can gain or you can lose. But the reality is you don't need to do business to play on the currency market. You can do that on your own investment, right? And in any case, as I said, in the long run, if you don't hedge, it can be proven that the expected value of your earnings will be lower, because you'll go through a period where obviously currencies will have a negative impact on your earnings, and then you will be missing liquidity at this point. That can drive you can mark then operating losses, and that can even drive some companies to bankruptcy. So it's I think, bad idea to just not hedge. And so yes, even if you make money right now on your commercial transaction because the forex is going your way, you can hedge to lock it, or you can use options to still have the upside, but at least protect your downside.
Yeah, and I think that's kind of the key point at this moment is perhaps there have been gains in the previous years, just that with the challenging economic environment we find ourselves in, there's a lot more pressure on profitability when we even just ignoring those currency risks. So there's still, obviously, we can take the gamble whether to expose ourselves to the gain, but is it something that businesses can do in the current environment, or could a small fluctuation downward create a lot of pressure on the balance sheet and the overall profitability of the company? So we have another question. Can you explain about improving profit margin through hedging if currently taking a buffer?
Yes, of course. So as I mentioned before, a lot of SMEs doing cross-border business, typically they're pricing a buffer into the transaction. That's something they do all the time. So when they decide to hedge properly, right? As we witness, I mean, some of these SMEs, they keep this buffer, right? So as they're a hedge, they just end up with this buffer, let's say it's 5 to 10%. They end up with an extra profit of 5 to 10% on top of their profit margin. Then they can choose whether they want to keep this buffer as an extra profit, or if they can use it, right, to be more competitive and sell more of their services and products.
Okay, thank you very much. We've got another question. We've got 5 minutes left. So I think this is more about your platform. So does it involve our local bank when using your hedging products?
Well, actually, as I mentioned, no, we're not using banks in what we do for this specific forex hedging, because they are intermediaries, right? So what we do, we use a broker that can provide us direct market access directly to the exchange, for instance, the Hong Kong Futures Exchange. That means that the SME has a direct access to the listed FX market and can trade mid-market or very close to mid-market, right? And also, the SME doesn't need to have a credit line with a bank, so it's much cheaper, no intermediary service fees, so it's cheaper and no counterparty risk, right? And also, the SME, by using basically trading directly on an exchange, has a complete visibility on the price as well. So no, we don't use any local banks as far as our hedging solutions are concerned.
Okay, thank you, Alan. I think one maybe final question that we can raise is, you know, if an SME does want to embark on an FX hedging process, what would be the first step that they should go through?
Yes, well, obviously the first step is, you know, to understand what the risks are. So as I mentioned, so the first step would be to understand basically their risk, the currency risk they are running. And to do that, as I mentioned, they need to perform a full currency risk analysis, which is the first step of the hedging process I described before. So to do that professionally, they may want to consult with a Forex hedging solution provider like us, for instance, so they can come up with a complete analysis and a report with respect to their currency risk that can, of course, allow the design of a hedging program to hedge their currency risk.
Okay, and I think we've got time. One final question was, who are the top brokers offering this type of service?
The top brokers, so I don't know exactly, so yeah, for direct market access, I mean, there are many brokers. I mean, for the direct market, you can use, you know, for instance, Interactive Brokers would be one of the biggest and the cheapest. So as far as we're concerned, for instance, Interactive Brokers is a tool that is used to have direct market access. And so that's, there are many others, but that's, for instance, that's the one that we like to use because they are the cheapest.
Okay, thank you.
I hope I answered the question.
Thank you. Yeah, so I think we've got a couple of minutes, so maybe we'll wrap up today's session. So thank you for your time, Alan. Really enjoyed the discussion. If anyone else on the call does have any further questions, then please feel free to send them to Alan or myself, and we will try to give some responses to those. So I'd just like to add some closing remarks. So, so firstly, thank you to all of you who've taken your time over lunch today to join today's session. I really hope you found it useful. Obviously, thank you to the Canadian Chamber for organising today's event, and I really appreciate all the effort that you've been through. And just a final one from me. So the economic research paper I mentioned at the beginning, if you do want to have a look at that, you can go to www.icaew.com. So over to you, Alan, if you have any closing remarks.
Just as a reminder, for those who would like a free currency risk analysis and case study specific to their company, please don't hesitate to contact us. Again, thank you, Ryan, for moderating, and the Canadian Chambers for hosting. Thank you very much for your attention.